So hello everyone, my name is Eugenia. Um, Hello guys, welcome to our webinar, which is devoted today to UK's manufacturing production and its release. I hope my colleague Alex will join me soon. I'm sorry, not Michael, I guess Michael is here today for the trading strategy. Yeah, hi Michael. So yes, we're gonna discuss some UK data, well, actually, UK manufacturing has been hit hard due to recent developments in the world. Well, I'm speaking about definitely China's economic slowdown as well as strong pound. And in fact, Britain's Manufacturers Organization, EEF, has recently halved its forecast for growth of manufacturing sector this year after overseas orders dropped to the lowest level since the financial crisis. British manufacturing expanded 3.1% last year, and it was the best performance since 2010. However, the EEF Manufacturers Organization said on Monday that it expected growth to slow this year to just 0.7%, and this compares to an earlier forecast of 1.5% growth. And the EEF said that proportion of British manufacturers reporting growth was the lowest since late 2009, and the new export orders had edged down to the lowest level in 6 years. Well, as I said, UK factories struggled in August as the strength of sterling and sluggish foreign demand continues to weigh on the manufacturing sector. And if we take a look at the recent data from Market Economics on the manufacturing PMI, the index dropped to 51.5 last month from 51.9 in July. And the reading appeared to be well below the long-term average of 54.2. But still, the positive news are that the reading remained in the green territory above the very crucial 50-point mark threshold, which indicates expansion, albeit slower than expected expansion in the sector. So today's data is expected to show flat results as the median forecast of economists who took part in the Bloomberg survey expected just the same 0.2% growth as in July. So here you can see the highest estimate that was 0.4%, while the lowest stood at minus 0.4%. And if we take a look, a closer look on this table, here you can see the top three forecasters, and all of them expect the same result of 0.2% as in July. So, but judging from the chart here, let me put me somewhere here. You can see that the gauge is very volatile, and yeah, it could drop or it could rise quite substantially within just 1 month. So, and if we take a look at the expectations of our community members, you can see that the majority of community members who took part in the fundamental analysis contest expect a bearish impact on the pound versus the US dollar. Well, around 59% of those expected a bearish impact. And I couldn't find any kind of bullish comments, so this is the only bearish comment that I liked, and the only, yeah, and no bullish, I'm sorry for this. So, but please next time make sure that you also share your views, bearish or bullish, doesn't matter. So, I guess it's time for us to switch to trading strategy by Michael. So, Michael, the whiteboard is all yours.
Thank you, Eugenia. Hello, everybody, once again. So, for today's day release, we've got the positive surprise trading strategy. Since the data is expected to remain flat, thus it will still be rather positive for the sterling, since it's a gauge of the UK's GDP, and basically it means that it's going to rise. So I've chosen the cable currency pair, the most common one, and the sentiment for the given pair is rather bullish at 53.09%, with the sterling being bought in 53.31% of all cases, and the US dollar being sold in almost 50%, also of all cases. Concerning the pending orders, we can see that both in the 50 and 100 pip range they are to purchase the British pound. In 50 pip range it's 55.17%, and in the 100 pip range it's slightly less, just 1% above the 1 percentage point above the equilibrium, so 51.02. Market sentiments of other market participants are also bullish, with the exception of the Saxo group. They got 54.23% short positions. The daily FX has almost 3/4 of long positions, and Land has a bullish sentiment of 52%. So that supports our sentiment, suggesting that the pair will rise today. So concerning the market reaction table, where we see the market reactions for the previous 5 data releases concerning the manufacturing production, the largest reaction was 47 pips, and the smallest one was only 16 pips. So the approximate average reaction we could expect today is 29 pips. And based on this reaction, we've set the take profit and stop loss levels accordingly. The take profit level, as you can see, at 1.5417, where we have the 4-hour R2 located, so it's bolstering this level. In case the pair does rise, we should not see a rally above this level, while the stop loss level is located at 1.5359, also quite close to the daily pivot point. So that is a quite good floor, which will prevent the pair from declining further in case we do see a fall. Also, we have another slight cluster of represented by the 4-hour S1 and the weekly R1, which could also influence the decline and prevent it even at this point. Also, the 55-period simple moving average recently pierced the 200 one over here to the downside, so giving us a sell signal, while the 21 has pierced the 55 one to the upside, giving us a signal to buy. So there are really contradictory signals here, and then I would suggest to pay attention to the technical indicators, specifically on the 30-minute time frame indicator, which is giving us bearish signals, so supporting the fact that the pair will decline. This is the most important indicator in this time frame, since it was updated specifically for this day release 30 minutes ago, and should be the most precise one. And yes, we do see a decline after all. I'm guessing the data was worse than anticipated. reaction is right now exactly 29 pips, but since the pair went slightly up, hence we don't see the stop loss level being reached. And we have the data in the chat. The manufacturing production is a lot worse than anticipated. It declined to minus 0.8%, down from 0.2. The industrial production also remained flat, but didn't meet the forecast. So we've got worse data there as well, and the trade balance, of course. So basically, everything was worse. Hence, we see the cable decline, and we had the reaction we did expect, just exactly 29 pips. So it's also a good sign, and the cluster around 53.65, around 1.5365 did manage to stop the fall around here. So I guess you didn't, guys. I hope you guys had a good trade, and guess that sums up today's data release. And back to you, Eugenia.
Thank you, Michael, so very much. So yeah, the data is considerably worse than expected, unfortunately, but yeah, let's keep following the UK fundamentals, have a wider picture of where the economy is heading. So thank you so much to Yang Zi and to everyone who joined us today. Please don't forget that we are having a daily webinar today at 12 GMT, so everyone is welcome to join. But meanwhile, have a nice day and take care. Bye.